Welcome to Total Money Management. I'm back here with Steve Moriarty.
That's me.
Full name today.
Hey, how are you, mate?
I'm good, mate. Yeah, it's been a wild week, hasn't it?
It has. This is a Wednesday. We're doing this, folks, because of the of Alfred.
Old Cyclone Alfie.
Cyclone Alfie. So,
I tell you what, my parents back in the UK mum back in the UK was terrified because she's never seen a cyclone before.
Right.
And I lost service and internet and power.
Right.
And so the last message I sent her about 5 minutes before the power cut out was cyclone about to hit. And then,
we're all done.
Yeah. And then 24 hours later, just bing, 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 bing.
Oh,
She's just
dear.
shitting herself. Well,
Mate,
anyway.
parents, I can tell you, as a parent, yeah, it's true. It's true.
Oh, but we're all okay. Damage free.
Yeah, it was a sort of, well, I shouldn't say it's an anticlimax. It was at my place anyway. It was a bit of wind, a lot of wind and a lot of rain, but it was nowhere near as bad as I thought it was going to be.
No, I think Gold Coast got smacked.
Yeah. I think the Gold and the Sunny were the one that really copped it.
Yeah, a lot of rain. Anyway, this week we're covering Feb 24 to 28, and we're going to probably spend a bit of time on old Donald Trump again and the absolute mayhem he's causing.
Why not?
But as well, there's a few questions that have come in on through the socials the last few days, particular.
Right.
And so let's cover a few of those. I'm sure more than a few people are thinking the same thing right now, as in, what shall I do with my investments? Because they're negative.
I was saying to someone, I think it was today actually. Yeah, this morning. I was saying to someone, usually I get a lot of phone calls when the market drops.
Yeah.
Hey, how are you, Steve?
Steve, I was talking.
I was just thinking about you the other day.
Yeah.
Of course you were. What do you think of the market?
Yeah. We've all been saying it's overvalued for about 5 years.
yeah. But it's anyway, that's what we do. What have we got? Pictures, mate. Pictures.
Yeah, the first one.
Surprise, surprise.
I mean, look, it's showing over how many 2.2 standard deviation above the historical trend. But this is the Buffett indicator. So let's talk about what the Buffett indicator is.
Market cap to GDP,
which is
essentially what Warren Buffett said. It's not genuinely just his, but what Buffett said was GDP is everything that's produced in the economy, right? What Buffett said was if you can get stocks at about 80% market cap to GDP, that's probably a good, a fair buy.
Yeah.
Right? So when you think, you've got to remember the S&P 500 is only 500 companies. Now they're big.
And they can change.
And they're big companies, but there's a lot, there's millions of mum and dad in businesses, that are not on the S&P, but they're producing stuff, so they contribute to GDP. Yeah. So what Buffett is saying is, well, look, the S&P is about 80% of GDP. Well, if you can get it at 80%, it's like, you're buying it even.
Right.
If the market cap to GDP falls lower, what that generally means is the companies are underpriced, right? So therefore, if you can get it at 60% of GDP, the companies are cheap, you should buy them.
Yeah.
Right? If it's more than that, you should really have a look at it. And in the negative, like it is now,
you should.
Where he's saying, listen, it's at 2. It's a really long way from 1.
Yeah, try and avoid it as much as possible. Yeah. Or is there something better to look at?
Yeah, if you look at all these valuation indicators, they're all looking about double the long term average, right? Like this one, Buffett's ratio. The Shiller Cape is, double 17 plus a little bit. Price to sales, price to book, the Q ratio, all of them are about, the long-term average is 10, they're at 20. The long-term average is 46, it's at, 85 or 90. So you're seeing that, and this is where you get the loss of 50%, which takes you back to the average.
Yeah, and it's important to talk about that. They're held up by the Magnificent Seven as well, really. Like, everything's had a bit of a good run.
Yes.
But the reason that it's this high is because the Mag 7 has done so well the last 10 years or so. Yep.
If you go to the next picture, mate, go to that one. That's the Buffett indicator, okay? Which is the annual stock market value is 62 trillion. GDP's, roughly about 30. So there you go, 211, right? So if Buffett's saying if you can pick it up at 80, you're doing well. So from 211, you'd have to get the total stock market to be about 24 trillion. So at the moment it's at 62. So that's where you go, that's a long way to fall.
Yeah. So I guess what should people do then? And that's one of the questions someone asked the other day. Like, we know it's expensive. What do we do?
Yeah, well, be prudent.
Yeah.
In all seriousness, that it's got this. When you have a secular bull market, what you find is everybody wants to do something all the time. So nobody wants to sit on their backside and go, I'll just wait until this market cools down a little bit. So my thoughts would be that when the market's really expensive, well, you just have to sit there, or you have to, if you've had a long-term portfolio, rebalance more, right? I think I wrote in the blog last week, which will probably be 2 weeks when this comes out. What I said was, if you started with 100 grand in 2009, right, and you go, I'm going to put money in the stock market, you're buying 100 grand in, now you've got 500, right, which is not an exaggeration. So you're looking at it going, man, this is great. You and I come along and go, listen, dude, you really need to rebalance, and you should probably sell down 300,000 of that, right? Maybe even more. Most people would go, oh man, that's crazy, right? I'll sell down 50, right? So if the market crashes 50%, which historically is average, right? So you're 500, you say, okay, I'll take 50. Okay, so you've got now you've got 450 and 50. Your 450 then goes to 225. So with your 50, you've now got 275. You haven't got 500 anymore, right? So from 100, you've gone to 500, but then because you didn't sell, you've now got 275.
Because it's unrealised, yeah.
Now, if you said, Steve, you're a bloody genius, I'll sell $350,000 worth, right? Now you've got 350 in cash and you've got 150 in stocks. Now your 150 goes to 75. 75 plus 350 is 425.
Yeah.
So now you're looking at it going, I don't care, I've got heaps of cash.
And you've just bought more stock at lower. When this number here, the 211, gets more like 100.
That's right.
You just bought a lot more stock.
You've got this is where the benefits of cash are really, really important, right? Because it gives you the option, right? And I think we had a quote, might have been last week or something, where Buffett said, cash is the worst of all options except when you need it or something, but that idea of, what do I do with this cash? And what you're thinking is, in a bull market, what your line of thinking is, I'm losing money by not being in the stock market or being in the property market or being in crypto. Yeah. Whereas what Buffett says is, that's the idea. You've got to wait for it to be cheap, right? And that means you've got to wait and rebalance through the bull market. Like he did, right? He just sold half of his Apple stuff, right? He just sold a big heap of Bank of America. Now, you imagine saying, I've made an absolute bucket load on Apple, but I'm going to sell half of it.
Isn't it funny that a couple of months before all this
starts going, everything goes pear-shaped. But look, I can tell you, mate, the old guy knows. Yeah. He just knows, he's seen it all before.
Yeah. It doesn't take a genius to look at these indicators and go, oh, if you're looking at it unemotionally,
yes,
and you didn't have anything in the market, you're like, oh, well, you shouldn't get in there. So there's kind of two sides to it, isn't there? There's, you've either made some money in the market over the last few years and you've got fear of missing out on the next run, or you don't have anything in the market and you've got fear of missing out because your mates have just made money. And these people should probably wait.
Yeah. It's just. Again, it all you look at those market cycle charts, you look at the CAPE ratio, you look at those indicators. People can bag them for a long time, but the reality is you make money and you build wealth by not losing money. And most people lose money, not in that sense of saying, oh, I bet on red and it turned out to be black. What they did was they say, I just over bet on red, right, by not rebalancing at the top. Yeah. Right, and I'm not saying, it's a breeze, because the other thing is too, you say to people ask me, well, how much do I rebalance? Yeah. well, 80% or 60 or 40 or 20, you know, and then if you say, oh, well, take 70% off, and then they go, oh, you know, 6 months later, it's like, oh, you idiot, you know, the bloody market's gone up another 10%. Yeah. It's just the way it works because it's not a science, you know. But the important thing to remember is you're investing over time, right? You know, you're 30. You're going to see another bull market.
I hope so.
You know, yeah, but you know what I mean? Like, don't sweat it. There's going to be a bull market.
Yeah.
That's the thing to remember.
Like, now's the time for people wanting to get in the market to actually do some research and look at history.
Absolutely.
Go, rather than piling in now, I'll do my research now and then I'm ready to go.
Absolutely. You know, what is it? You know, be prepared or, you know,
prepare to fail or fail to prepare.
Yeah, you know, it's there's sort of preparation's the best way to go about it.
Yeah. And that itches the scratch as well. I mean, remember when I first started looking at it years ago, wanting to just throw all my cash into it. And if you do research and actually look at your history, that itches the scratch, and you can kind of judge when to get in, when the best time to get in.
Just start small. Yeah. Right? Just start small, and then if you're right, well, it doesn't matter. You'll make money. Don't worry about it. You'll be fine.
Let's talk about quickly platforms to use. So in Australia, what are a couple of good platforms to use for people wanting to start?
Well, there's a difference between there's lots of platforms these days, and there's also lots of sort of places to get, you know, CAPE and all that sort of stuff. But in terms of trading platforms, the 4 big banks have all got a platform, right? Yep. CommSec, ANZ's got, you know, ANZ is really CMC Markets. They've got a platform. There's another few, I think it's Stake, Self Wealth, NAB's got one. You know, there's heaps to choose from.
Beta Shares.
They're all fairly sort of similar. They might have odd differences. The only thing I would say to people is just make sure that, look, to be quite honest, it's better off going with one of the major ones. People will talk about transaction costs, but unless you're a day trader, you don't really need to worry whether you're paying $10 a trade or 19. You know, if you're a long-term investor, right? You're not going to be racking up thousands of dollars, you know, a year trading. Investing. Yep. If you're a trader, okay, you'll have more costs, right? And there's different platforms for that sort of stuff. Yep. Interactive Brokers is a really good global one. Basically, because, you know, as I say to people, you can buy bloody Russian pig trotters, you know, like, I want to buy Portuguese ducks. And it's like, yep, we've got a product for that. You know, here it is. It's like, right, okay. It's really crazy.
Oh, you put options.
Well, yeah. You can, the stuff you can buy is insane.
Yeah.
You know, and that none of those are a recommendation. It's just saying to people, look, generally, you know, they're all pretty much the same. If you bank with Westpac will have one. If you bank with ANZ will have one. And it's easy because then you can just link it to an account.
Yeah, I think it comes down to your trust at the end of the day. Like, if you trust the big banks, use their platforms, and you don't want to use some random Joe blogs.
Yeah. There's a few out there. The one major issue is when you're dealing with the 4 majors, you get, when you buy and sell stocks, they're in your name. There's a few out there that have really super low fees and stuff, but what you find is you don't actually own those shares. They're held in a trust, and it's a little bit different, and it's not as secure.
Yeah.
Right. So, but you've got to be careful of that sort of stuff, because you sort of go for it's $2 a trade. Cool, I'll go for that. But what you find out is that you don't actually hold those stocks. They're in a trust account. So things can get complicated.
Yeah. Especially if you're starting, just go for the simple ones.
Yeah.
All right, what's happening on Tuesday? This chart here is showing consumer optimism or consumer confidence.
Yep.
And it's looking okay. Bit of a win. I wouldn't say it's shooting the lights out.
No. The Australian economy is just gurgling, really. It's just, GDP growth is awful. It's less than, or something like 1%. I mean, that's terrible. Inflation's at 3 or 2.5. Well, you're still going backwards.
Yeah.
And lots of people are struggling with the mortgage and that sort of stuff.
The chat that we had before, people are paying 50-60% of their wage on
Yeah.
Mortgage, and you're just like, how's that sustainable?
Yep. It's just, I think I might have mentioned this before. There's a lot of people saying, like, oh, the restaurants are full and all that stuff. And it's like, well, of course, poor people don't go to a restaurant and not eat. You don't turn up and go, hello, I'd just like a table. What would you like? Nothing. I'm just making up the numbers. It's like, well, of course, it's like Survivor. They call it the survivorship bias, right? The only people you see in fancy restaurants are people who have got enough money to pay for the fancy restaurant.
Yeah.
Right? If you can't pay, well, you don't turn up.
Yeah. Or idiots using credit cards or something like that.
Well, yeah. But even when you say it's full, what you're doing is you're probably looking at the top 10 or 20% of income earners who can afford to go out. Right? Like I've said, a 200 gram eye fillet steak these days is like $50 in Brisbane. And I know it's even worse in Sydney, right? But, you go and have a steak and a glass of wine, it's $65 or $70.
Oh, easily, yeah.
It's just crazy. 2 people is $200 with one drink.
It seems to be that kind of class divide as well. It's getting worse, right? The people that have money have a lot of it, and the people that don't. Yeah,
the income distribution is terrible, right? And it's getting worse because the way the economy works, it's exponential. So when wealthy people make 10%, they make a lot of money, but their costs don't go up 10%. But when poor people make 10%, they make 10% of a lower figure, and when stuff goes up in inflation, it takes a really big chunk of their money and rent, right, for a start. Right? So it's a lot. My argument is there are a lot of people who are surviving. There's not that many that are thriving, right? There's a lot that are just, they don't want to see a recession because, if we get a recession and, we're talking about Donald Trump maybe bringing a recession to America, man, oh man, things, I can tell you, recessions are ugly.
Well, if the US goes into a recession, would that most likely kick us into one?
Not necessarily. It depends what the government responds with. All governments can avoid recessions. All they do is just spend a lot of money. And really, that's what they do. When it hits recession, well, nobody's going to the bank going, oh, I've got a great idea, I'm going to start a company. It's like during a recession, no one's got any money and people are losing their jobs, So there's only one cohort that can really say, all right, we'll spend the money. Who's that? Well, that's the government, right? And that's where you get government deficits. Kevin Rudd in the GFC, right? We'll spend a lot of money. We'll spend it on schools and we'll spend it on households. Scott Morrison in COVID, righto, we'll give you get a $25,000 renovators subsidy. We'll give people their wages. We'll spend a lot of money. We'll give money to business. And what happens? You get a bucket load of growth, right? That's the same in America. That's why America's booming, because Joe Biden spent, 6 to 7% of GDP.
Yeah.
Well, that's 6 to 7% more money in the economy, and in an economy, that's a lot.
Yeah, but now you've got Trump and Musk talking about how it needs to be paid back, otherwise they're going to go broke.
Yeah. Well, that's for another day. They're wrong. But the concern is that Musk does a lot of damage with cutting spending, that it creates a recession. One of the arguments is you can see they're moving towards that. They know they've got problems because what they're doing is saying, oh, it's still Joe Biden's economy. So in other words, if it stuffs up, don't blame us. It was Joe Biden.
We've only been here a few weeks.
Yeah. So, you can only dine out on that for so long. I think there's a lot of blowback coming against Donald Trump and particularly Elon Musk.
Yeah, well, he did a Fox interview the other day. He looked deflated. He looked defeated.
Yeah, he's probably, Tesla's down 45%, right? Now, if you're a Tesla holder, this is the important part. Those people who bought just prior to Tesla falling 45% now need 85% to get back to square. right? That's the point we always make. It depends when you buy it, right? Now, okay, it could bounce 85%. I don't know. But looking at the revenue and the sales and everybody going, Elon Musk is a wanker, he's an authoritarian, he's a Nazi.
You said it first, mate.
Yeah, I'm early. I'm prescient. But, my point being that his brand is now severely damaged. And I think you'll find, I reckon Musk won't be there by the end of the year.
Yeah, right. Calling it.
Well, I suspect
or it'll be in the background.
Listen, mate, when they start losing money, that's when it's like, Elon, you better shut up because the shareholders are getting a bit itchy about you running around telling the Germans how they should vote.
Yeah.
Calling people, retards and this sort of stuff. I mean, it's just crazy. It's just crazy, and he will do damage to his brand.
He already has. There was something I was reading that if Tesla gets down to a certain number, he'll be liquidated.
Well, he's probably borrowed a lot against the shares.
Yeah.
You can't go around cutting government services to the people who voted for the bloke you're, ponying up with, Donald Trump, and cutting all the services to those people and then going, yeah, but I'm a good guy. I mean, and the other side was that, Musk was a global saviour who was, saving the climate, and all this sort of bullshit. And there's people going, these cars suck. Who wants to be seen in a Tesla? Mm-hmm. There will be people going, oh, man, I don't think we'll buy one of those cars.
Oh, there's already people putting stands up against it saying we're absolutely not
Absolutely.
buying this. Countries are not shipping them in anymore. Like it's...
Yep. There are countries, I think we talked about it a couple of weeks ago, Carlos Slim. Musk went on and accused Carlos Slim of, I think, being a pedophile or something, right? Mm-hmm. And Carlos Slim said, who's a multi-billionaire in his own right, said, right, okay, cancel $25 billion worth of Starlink contracts.
Yeah, I remember seeing that.
That's when you think, hey, boss, can you just shut your mouth up? The few of us here want to keep the job going.
Oh, so I can see, hey? What's this? So US housing affordability. I didn't realise that it was an issue.
Housing affordability.
In the US.
Yes, it's affordability. And this is why we're talking about the commonalities throughout the globe of the problem with affordability.
Because there's no wage growth anyway, really.
Yep. And it's not just, again, it's about, and we're going to deal with this later in a separate podcast, but again, what you're finding is the only people who can buy houses are rich people. And what's happening is because wages are not rising enough, it's not enough for people on an average wage to buy a house anymore. Right? I was just saying to my mate this morning, 50 years ago, we survived on one wage, right? And mum stayed at home, right? And everybody had a home. The real down and outers, they got a housing commission home. They paid $20 a week rent and all that sort of stuff. But generally, you could buy a home on the average wage. One. These days, you got two average wages, you got no chance. It's just the Sydney prices now are like 1.7 million and stuff.
I mean, to save up 20% plus stamp duty as well, which is an absolute killer.
Yeah,
you're spending 50 to 80 grand on stamp duty.
Yep, and then what you're getting is also the fuel on that is mum and dads helping out their kids.
Yeah.
So if you haven't got a rich mum and dad, sorry, you're out of the market.
Or if you've got a couple of kids and the mum and dad are guarantor in one house.
Yeah.
The other kid's like, what about me?
Yeah. So, it's a really ugly situation.
Yeah.
And so, what I was putting that up there for was the record 47% of their income. Right? So, again, the long-term average used to be 25. Mm-hmm. If I remember correctly, banks wouldn't lend you more than 25%. Right, as a repayment.
I just can't believe that they've got back to this level again. Like
I know, but that's why the joint's bloody jumping, because everybody speculates in property.
They were there in 2007. Look in the mirror, man. For God's sake. How did you got back there?
See, you've got to remember now, mate. That's nearly 20 years ago.
Yeah.
That's a generation, right? Ireland did the same thing. Ireland crashed. Oh, a bloody nightmare. Next minute, boom. And it's just, again, this is why we're saying it's a flood of money, right? It's people borrowing. You know, I looked at this yesterday, and we're going to talk about this. By the time you hear this, it's probably too late. But we're in our masterclass.
No, this will be out. This will be out on Friday.
Oh, okay. Monday, yeah. So in Monday's masterclass, I've got a slide there about Australian property, right? And it's a really simple slide. It's from about 1990, I think, through to today. And what I want to show people is the credit borrowing has been going up at about 7.5% per year from year 2000. Wow. Okay, which is where everything goes crazy, right? Okay, now 7.5% of GDP is money borrowed. Now, if you are only getting GDP of 2%, then what that means is there's 5.5% of money being put into the economy unproductively.
Right.
Okay. Where's that money going? I'll tell you where it's going. It's going into people buying each other's properties, because that's, I have not produced anything. If I go to the bank and I say, Jacob, I love your $1 million property, I'm buying it for 1.5. I haven't produced anything. Now, if you get 1.5, people will say, "Oh, well, Jacob will do something." Yeah, he'll go to Bob and go, "Bob, I love your property. I'll buy it for 1.7." Right? So we're all binning up each other's existing properties, and so this is the real problem, and this is why you're getting landlords with 3, 4, and 5 properties, because they're leveraging up, right? And it's that thing where people are saying, "Oh, you just got to get on the property ladder," right? But my point being, the reason why we've exploded in house prices is because we've exploded in credit, right? The banks have just absolutely lent to heaps and heaps of people, right? And that's why I say to you, if it's 7.5% compounding, right, then, and if GDP in Australia has been, GDP's been shithouse for 20 years, it's probably, if I was going to really argue, 3%.
Yeah.
Well, what that means is there's about 3.5% to 4% of money in the economy that's not producing something.
Yeah, that's interesting.
And that's why I say, we're in for a hell of a show when it finishes. Yeah. And it can go on for a long time, but it can't go on forever.
Well, it has gone on for a long time, though,
absolutely.
Right? It's like it's getting to, in our opinion, to the end of that long time.
Absolutely.
Anyway.
But that's, again, more for Monday night. But that's the short story. Right? Yeah. The short story is you just can't keep borrowing, because you eventually run out of people to lend to.
Well, actually, let's talk about Monday night quickly. A bit of a plug. If you listen to this Friday, Saturday, Sunday, and you want to join on Monday night, it's a bit of a State of the Union masterclass on what's happening in the world and what to expect moving forward. It's
Donald Trump. They're eating the bats.
Free to join. Just send us an email. We'll send you the link to register. Thursday, fund managers are actually saying stocks are overvalued.
There you go. Look at that, eh?
Can't believe it.
I think I got in the week after. I think I've got 94% of fund managers fail to beat the index, right? Fucking bunch of losers. Now 90%. Now, the reason why that's important is because once the narrative changes, remember we talked about this before about, when the narrative changes, and we're doing this on, what are we doing it, mate? March the 12th.
Yep.
The last 2 weeks, the narrative's changed.
Right? It seems still early, though, to me.
Yeah, it is, absolutely. We've got a long way to go.
Yeah.
This is not one of those, it's a generational buying opportunity. It's like, no, it's not.
Well, you see on the socials now, people are going, it's dropped 20%, let's get it all in.
Yeah. Well, look, Tesla has gone down 45%. Yeah, but I don't hear too many people going, and this is a generational time to buy Tesla.
It's still overvalued, even dropping 45%.
Absolutely.
Friday.
It's hard to beat history, mate. It's hard to beat history.
S&P 500 trailing 4-quarter net profit. So let's try and explain these, because we've had a few people say, you guys are talking about these charts. I'm listening to this in the car, and I can't bloody look at it.
Keep your eyes on the road.
Yes.
Right. What I'm talking about here is net profit margins. Profit margins on average were about 7%, right, over time. If you go back like me and be nerdy, things like read Warren Buffett's old newsletters, Buffett talked about profit margins in, I think, it was 20 years ago or something. And he said, profit margins were at about 10%, right? Which is good, right? And Buffett was going, they can't keep it up at this level. It won't happen. It'll mean revert. Now, profit margins have been if you have a look there, profit margins have grown from 8% in 2000 to 12 or 13, right? So, again, the reason why we talk about income distribution is profit margins go to somebody, right? Now, if you're and this is what's been happening over the last 20 to 30 years in developed countries, particularly in places like America and Australia, what's happened is out of every dollar, and I'm using this as an example, in the old days, the boss would pay 20 in tax, he'd get 50 and the worker would get 30, right? And so when the productivity kicked in, let's say it then became 110, right? Or 120. Then they'd say, all right, well, tax is less now, so we're only paying 15 in tax, so there's 105 left over. But what happened was the bosses would now say, well, I'll take 80 and you get 25.
And
right?
suck it, yeah.
And that's the problem. So when you look at the long-term charts in productivity and worker productivity, what you find is the workers have been really productive, but they haven't gotten the equivalent in rising wages. So in other words, the bosses and the shareholders have been taking more of the profit.
Yeah.
Higher profits, higher take.
Yeah, and then higher resale value of the business when you
That's
flip
exactly
it.
right.
But if you look, 1970 to 1990, of basically 2000,
yep,
it doesn't really go anywhere. And then internet.
That's why. Well, it's not the internet. What it is, and again, it's a bit of we dealt with a little bit in property problems. Everything skews in 2000, right? It all goes crazy. And the part of it is from the Asian financial crisis in 97.
Right.
Right.
Like the money flow distributing.
Yeah. What happened was the Asians centres like Thailand and Malaysia, they were going gangbusters, right? And what happened was when they had the currency crisis, they then said, the IMF basically went in and said, righto, you got to be like America and you got to, sack all these staff and be efficient and stop this crony capitalism and all this sort of stuff, right? So the Asians went, yeah, well, get stuffed. We're not doing that. So what they did was they kept their currencies low and became ultra competitive. Now, the other thing is China enters the WTO.
Around this time?
Around 2000, right? So, of course, what happens? All the factories close down and move into China, right? But what it does, Jacob, is essentially it's about capital flows around the world, right? And essentially what happens, which is what Trump is trying to deal with now. So the Chinese are getting all this money, right, US dollars, and instead of turning into Chinese yuan and paying the workers more money, the Chinese workers go, man, this is great. We're buying washing machines and cars and all this stuff. The Chinese government saying, no, the workers can stay poor, right? We'll just keep them above poverty level and we'll buy US treasuries.
Okay, right.
So interest rates fall, the US becomes awash with money, right? Now, when a factory in the US closes, you've got 100 workers, right? So the company says, we're off to Guangzhou. Sorry, Alabama, we're out of here. There's 150 workers who have now got no job. So the government says, well, if we don't do anything, there'll be higher unemployment. So what do? They encourage people to lend, to borrow, right? Interest rates are really low, and so this is what you get. So you've had this rolling series of asset bubbles, right? And this is the problem. The problem is this huge debt. The debt to GDP in the world ratio in the world economy is about 330.
Yeah, but it's never going to be ever paid down.
Well, this is the problem. It won't be paid down, but there's going to be a shitload of people go bankrupt.
Yeah.
Right. So this is why we have the boom and the bust. Right. So
particularly in the US,
1982 to 1999, 2000, you make lots of money. Right. Boom, loses 50%. Next 4 years, it doubles. Fantastic. Next, after that, boom, loses 50%. From 2009 to 2025,
it's just gone.
We've gone crazy again. So, what do you reckon's coming next?
Yeah.
Right? It can't keep going on forever.
Yeah. Well, I mean, you've talked about it a few times. It may not be a quick boom. It may be a slow release boom.
Yeah, it might be like Japan because there's just so much debt.
Yeah.
You know, this is why I say Australian property's worth $11.5 trillion. I mean, fucking insane. It's crazy.
It'd make the GFC look tiny.
Oh, mate, it'd be a sideshow.
Yeah.
You know, and again, if you look at all the indicators, we've gone back up, like you pointed out before, we've gone back above where we were in the bloody GFC. Yeah. You know, like Cape in the GFC was 27. Now it's 38. You know, like that's what I mean. You look at it and go, oh, man, this is going to... Well, you got a choice. You know, this is what NVIDIA's valuation, Tesla's valuation, you know, Costco, a supermarket's got a PE of 60, right? 60 for a supermarket, right? Walmart's got a PE of like 50 or something. I mean, it's just nuts. And it's the flood of money.
Everyone's drinking the Kool-Aid.
Absolutely.
All right,
more overvaluation.
Is that just the same thing?
Well, 29, 66 and 99. And here we are again. So, you know... Yep. What happened after those last three times? Those three occasions, it fell 50 to 60 to 70%.
Well, this is what we've just talked about, right?
Yeah. And so someone better come up with a goddamn reason why it's not going to do that again. And I can tell you, it's not going to be AI or any technology bullshit because I've saw it in the internet bubble, you know, like, oh, it's going to change the world. Good. Crash. Yeah.
What's the lesson of the week, Stephen?
That one is just showing people that, as you can see, the Hang Seng is the Hong Kong index. What I want to point out to people there is really important. This is why you rebalance, folks, right? Because if you're rebalancing on the way down, by the time it gets back to where it was 3 years ago, if you bought there and went on to a desert island and didn't buy anymore, you come back and you go, oh man, 3 years and I haven't made a cracker.
So this is a buy and hold versus rebalancing.
Well, yeah, and a couple of things. It's an index for a start, right? It's not, you know, Hong Kong's probably not going to blow up.
No.
Now, this is why we say asset allocation is holding some money in cash because if you're wrong, i.e. if you're wrong for, you know, 2022, right, you're buying all the way down and selling and rebalancing. So what I'm saying is by the time it gets back there for buy and hold, you're already making money because you've been buying it as it's falling.
Down here in October where it drops a bunch.
Right?
Yeah.
Even if you're just you're buying periodically, your price will be, you're lowering your average price.
Yeah.
Right? And that's my warning to property investors. You can't average down a property. Right? You can't say, oh, you know, my 2 million's now worth 1.5. Oh, it's cool, I'll just buy more of it. Well, you can't. Right? Whereas with stocks, you can at least say, I bought it at $1, it's fallen to 80 cents. Okay, I'm going to buy some more. And now my average price is 90 cents, not $1.
Yeah.
Right? That's what I'm trying to show people there.
I think it seems fairly obvious as well. And it's slightly different to dollar cost averaging as well.
Yeah, it's sort of dollar cost averaging, but what we're saying is you just need to use it in conjunction with valuation, you know, and that sort of stuff.
Yeah, yeah.
Right? But it's not blindly buying every month either, dollar cost averaging.
Well, that's what I'm saying. That works to an extent if you're a proper novice.
Yeah.
But if you just do a little bit of research into valuation, you realise that you don't need to do that either.
Yeah, yeah.
Anyway, we'll leave that for another week. Thanks for joining us, Steve.
Thanks for listening. Cheers, folks.
Bye.
As always, remember, we don't provide financial advice.